Hi, and welcome to Early Retirement Roadmap, the show where I help you prepare for and thrive in early retirement. Ever worked for years at a previous company and built up a big 401k and now wish you could use those funds before 59 and a half to retire early without getting penalized by the IRS? And since the rule of 55 doesn't apply, is there any other option to access these 401k funds early without penalty? Surprisingly, there is, and very few people seem to know about it. Today, we're covering a legal but strict IRS loophole, Rule 72T, that lets you pull from your 401k or IRA early, penalty-free. But be aware, this option comes with some serious strings attached, including a rarely discussed risk that can derail your retirement if you're not careful. If you want early access to retirement money and have few other choices, this may be the door you're looking for. Today, I'm going to break down how it works, when it makes sense, and what you must know before you touch a dime using this strategy. Before we dive completely into it, if you're working towards early retirement, be sure to grab my free checklist, 12 Must-Do Steps to Retire Sooner and Smarter. It's packed with practical tips to help you make the most of your money in your retirement years. You'll find the download link in the description or show notes. So what exactly is IRS Rule 72T? IRS Rule 72T lets you avoid the 10% early withdrawal penalty on retirement accounts if you commit to substantially equal periodic payments or SEPPs for at least 5 years or until age 59 and a half, whichever is longer. You can use 72T with a traditional IRA, Roth IRA with some caveats, or a 401k, as long as you're no longer working at the company sponsoring the 401k. So for example, let's say you're any age under 59 and a half and you have a large 401k from a previous employer, or perhaps you are 55 or older, but you don't have a lot of money in your current employer's 401k to retire early on. Rule 72T is the way to tap those funds early without penalty. So how does it work and how strict is it? Well, it's very strict, and here's the details on how it works. First, you must withdraw the same set amount every year, and those withdrawals must continue uninterrupted for at least 5 years or until age 59 and a half, whichever is longer. So for example, if you start the SEPPs at age 57, you'll be locked in until age 62. If you start at 58 and a half, you still have to continue until age 63 and a half, 5 full years. If you start at age 53, you must continue at 59 and a half, as in this case, 59 and a half is longer. And once started, there can be absolutely no changes. No stopping, reducing, or adjusting. This is a one-time irrevocable election. Once you start, you're locked in. There are no exceptions for financial hardship, life changes, or even if the IRS changes its rules. Deviate at your peril. The penalties and interest will be applied retroactively to all withdrawals made under the plan. So you can see there's some real risk with using IRS Rule 72T. First, you have the rigid withdrawal problem. Life happens. For example, there can be market drops or your retirement expenses may shift. But under 72T, you are locked into those withdrawals with zero flexibility. Second, and a big one, there's sequence of returns risk. If the market tanks in your set period, you're forced to keep selling investments at lower prices. This amplifies your losses and can drain your savings much faster, making recovery extremely difficult when the market later rebounds. Unlike most flexible accounts like a taxable brokerage, you can't scale withdrawals back or pause them. That's why sequence of returns risk is especially dangerous under Rule 72T. Third, there can be tax consequences. Because most people use this to withdraw from their 401k or traditional IRA, every withdrawal counts as ordinary income, which in turn affects your modified adjusted gross income or MAGI, which impacts subsidies you can qualify for if you're on an ACA market plan for health insurance, since subsidy assistance is based upon your MAGI. And if you're using this to withdraw early from a Roth IRA or 401k before age 59 and a half, the portion of each withdrawal that comes from earnings is treated as taxable income and counts towards your MAGI. Rule 72T only waives the 10% early withdrawal penalty. It does not waive income taxes on earnings since you're withdrawing before age 59 and a half. As such, these are non-qualified distributions, and earnings are still taxable even if the account has been open for more than 5 years. Only your original Roth contributions are tax and MAGI free, but 72T withdrawals are fixed and usually include both contributions and earnings, so some of the withdrawal will be taxable and can impact things like ACA subsidies. And this is not so much a risk, but something you have to be very diligent about if you do this. Because the rules are so strict, it's vital to keep detailed records of your SEPP calculations and withdrawals. Because if you get audited, you're responsible for proving you followed the rules to the letter. If your records are incomplete or inaccurate, you could face penalties even if you did everything right. So with all this in mind, when does it make sense to use Rule 72T? Really, in a couple of circumstances. You're retiring well before 59 and a half and need ongoing income from retirement accounts. Taxable brokerage accounts, Roth contributions, or the Rule of 55 aren't options, which are certainly the better alternatives to fund an early retirement. Why? Let's talk about the alternatives briefly. First off, a brokerage account is safer and more flexible. You have control over when and how much to realize in capital gains, and that can help you manage your MAGI for ACA subsidies. For example, you can sell higher cost basis shares or harvest losses to stay under subsidy close. Roth IRAs allow tax-free withdrawals of contributions and don't affect MAGI. And the Rule of 55 applies only to 401ks from your current employer if you retire from them at 55 or older. But remember, those withdrawals are taxable and do count towards MAGI for ACA premiums. So bottom line regarding IRS Rule 72T, it's good to know it's an option to fund an early retirement, but think really hard before deciding to do it. The lack of flexibility and risk of sequence of returns have the potential to devastate your retirement if markets turn south. Before pulling this trigger, you really need to think it through carefully and consult not just with a financial planner, but with a qualified tax professional or CPA who has deep experience with IRS Rule 72T. The tax and legal complexities here are extreme, and a mistake can cost you thousands of penalties and interest. Do not, I repeat, do not DIY this. Get expert help. And before you go, don't forget to download my free guide, 12 Must Do Steps to Retire Sooner and Smarter. Whether you're planning your exit or already retired, it's a helpful tool to make sure you've covered the key bases. The link is in the description or the show notes. If this episode helped you, hit like, subscribe, leave a review depending on the platform you're on, and go to mikeupland.com for all of my media, including my blog. Thanks for listening. Until next time, this is Mike Upland, early retiree, last year at age 55, helping you to achieve and thrive in early retirement. Take care and make the most of today.